Augusto, thank you for that question, and Nacho as well. And I'm going to take all the I asked whether we should have questions during, but it's because of the recording, it's best to take them at the end. So Augusto and Nacho, thank you. They're very good questions, both of them. But if it's okay, when we finish the recording, I'll answer those. I think that was Lewis's idea, that that we do it that way. So, sorry, that was just from Tuesday, and today we are going to be talking about initial coin offerings. And there was just one site before I get onto this subject that I didn't show you. I think I forgot the link. So instead, I'm just going to revise what I did in the introductory section, because I find if you are teaching or talking to any friends about Bitcoin and what it is, because a lot of people don't really understand it, this is a very nice visualization. This is a large block, which means that the latest block, 2 blocks. Right, this is something I've never seen before. It would be just when, because this is a live simulation. Why on earth they have 2 blocks there? The average time is supposed to be 10 minutes. And the algorithm has got a difficulty attached to it to regulate the time, but it's quite stochastic. And it could be that a block, for example, that was 67485, and this is the next one, by chance happened to arrive very soon afterwards. Having said that, I'm not quite sure why it's not doing what it should normally do. So a bit like the BitMEX exchange that won't wake up for another half an hour or two. Oh, there we are. That's these balls are the transactions in the block, and the ordinary Bitcoin blockchain, not counting the Omni layer or anything like that, is only used for transferring Bitcoin. So the larger the ball, the larger the number of Bitcoin, and some of those very large blue ones had something like 100 Bitcoin. So given how much the value of Bitcoin is, well, call it value, the price, a market price of Bitcoin is at the moment, it's not really a value. That's a lot of money that's being transferred along the Bitcoin blockchain, but it's all completely transparent. You can go into a block explorer and find everything about it. So if I, for example, go to just any blockchain explorer, this will automatically take me to a Bitcoin one. Actually, no, this also has Ether and others. So there are so many of these. I just typed in any one and went, although this was the original one with just for Bitcoin, rather responsible for why so many people confused blockchain and Bitcoin, and they thought they were the same, which is of course completely different. Anyway, so this is just the price of the coin. This is the size of the memory pool. So there are lots of different types of nodes on the network, and some of them are just what we call light nodes. And their purpose is simply to verify that there's been no double spend. So if we look at the latest transaction hash here, this transaction is summarized by this amount of Bitcoin from a previous transaction is this much, is going to this address and to this address. So in total, you've got previous transactions will go to this person here. All these previous transactions totaling, actually it's this address here, totaling 0.00766 of a Bitcoin. So that is what's sent. But then the what we call the UTXO, the bit that this recipient, this wallet, has been overpaid, goes back to this address. So just to restate that, the way the blocks are, or the transactions are made, is that you have to go from this address here with previous transactions. So a previous transaction to this address was 090870 Bitcoin, and that was a previous transaction, and that was a previous transaction. And actually, it's going, most of it's going here, some of it's going here. This could just be the fee, that the more the fee, the more likely this transaction will be taken from the mempool. So this mempool goes up and down in size. That's just over a day. But if we look at the last 30 days, you could have 90 million transactions at any point in time in the mempool. And now it's a bit lower. So this was obviously quite a high volume period. And the miners will gather all these transactions to a maximum of about 1.5 Bitcoin. And I'm sorry, megabytes. So the data in the transaction has varying size. For example, the transaction that also in the notes had a video was a very, very large size transaction, probably took up most of a block. And then they hash them all together with this SHA-256 and come up with a hash that, for example, this could be a hexadecimal number, which is the final one, putting all those transactions together. And then the idea is to find another 64-bit hex. Maybe try this, let's try that one. And what happens if we hash that together with this one and generate? Okay, it doesn't begin with 10 zeros, 0, 0, 0, 0, 0. So we have to try another one that we hash with this final block. And we keep trying and hash and hash and hash and hash and hash. And that's why you see this hash rate, because that's the hashing of random hexadecimal numbers with your root transaction in the block. So if we look at the latest block, that was 1 minute ago, that was the block hash, and it's got the number of zeros. Obviously, the probability of 1 0 is 1/16. The probability of randomly getting 2 zeros is 1/16 squared, or 1/2 to the 8th, and so forth and so forth. So the probability of finding a random hex that, when hashed with the block header hex, gives you lots of these zeros is very, very, very low. However, it can happen that you're, just by chance, it happens very quickly. But this difficulty, the number of zeros, is adjusted depending on how busy the miners are. If there's a lot of them working at the moment, then the difficulty goes up, another 0 is added. If not many of them are online and are building blocks, then you could have only 6 zeros. Sometimes you could have 20 zeros. Anyway, so that was the time in what we call, everything is UTC time, okay? So that's the same as GMT, except during the summer, when we changed to a different time. This was an unknown miner. There were 2,279 transactions. So the Merkle tree started with 200, including one of those will be the fee coming back to the miner for the 6.125 Bitcoin reward. But each of those transactions may or may not have an extra fee to the miner. So when you look at this mempool with 85 million transactions, the ones that have got the biggest fees will be taken first. And then the miners are probably taking, particularly one who's got a very, very large fee, they'll all be having that in their block because they get all the fees as well as the 6.125 reward. And then they compete, they hash and hash and hash, and they need a very powerful machine. That's why these mining farms have been built in Siberia and places like that. I'll just show you some photos of these things, more images. They're all over the world now. These in Montana, in Siberia, in Iceland. This is inside Russia's largest Bitcoin mine here. So these special machines are generating random hashes to solve that problem. This is called the proof of work. And because it takes on average 10 minutes, you can't change previous blocks unless you're able to redo that every block and hash and hash and hash and redo the whole thing. Because if you change something, anything in a transaction, because of this avalanche effect, you know, we add a tiny little thing and the entire hash just changes. That's called the avalanche effect. So you can't change anything without changing one hex in the tree. And then everything changes. So the entire block changes. That's why the blockchain is immutable. It's secure, and it's secured by the network competing against each other. Even though there are these large mining farms, and these farms then combine together to form mining pools. So let me just 9 best mining pools. Most of them are in China, Czech Republic, Iceland, Japan, Georgia. Okay, and for example, slush pool. We shall see if we look on the blockchain. Well, latest blocks all unknown. That's not very helpful, is it? Let's go to a better explorer. I'll go back to, I've got the Ether scan here. Yeah, here we are. So this is a better explorer. These are showing the transactions. And when it says 0 Ether, that's because it's a smart contract transaction, an instruction to do something like transfer a token to a different place on the blockchain. In terms of the mining pools, let's go back here. Spark pool, that's this pool here. So Spark pool is being very efficient at the moment, but there are, let me see if I can get more information on the different types of mining pools. Slush pool, that was the first one. This one has a distribution of the pools. At the moment, it changed a lot. So slush pool is there, it's not doing so much. F2 pools being active, pool in Ant pool Huobi via BTC. It sounds to me like slush pool may have been doing quite a lot for Ether, but less on the Bitcoin. As I said, we are now, because of what's happened in crypto, we're living in an information where the data overload is really a problem. There are new companies now coming, trying to deal with the amount of data there are. Anyway, so here we can see the hash rate, probably, hash rate. So 160 million terahashes per second. So as I said, this is not tenable in terms of using more electricity than the whole of Denmark or other countries. You can get so much information on miners' revenues. This is the difficulty. Okay, this also tells you how they go hand in hand. This is periodically reset every 2 weeks, that difficulty. And then the miners, I'll talk tomorrow, on Thursday, I'll talk about hedging Bitcoin and how to do that with these strange contracts called perpetual swaps. But the income from miners' revenue is quite considerable. Like obviously, this is measured in USD, so it goes up with the price of Bitcoin. Okay, so I'm going to take those questions later. Thank you both, Augusto and Nacho, very much. But for now, I'm going to see if I can talk about these strange initial coin offerings to answer some of those questions possibly. So an initial coin offering is a launch of a new coin or token, or it can be a repeat. For example, EOS had an initial coin offering. I'll show you some details of that. And then it had a second one. So it was a sort of second coin offering. It's a little bit like equities have an initial public offering, but then they may release more of the capital from the company as equity as time evolves. And this is quite an old map from what I've found. This is like 2 years old. It still sort of applies that if you split the 5,000 or so coins into tokens, you get some that are just payment tokens like Zen coin or Zcash, Bitcoin, of course, although Bitcoin was not an initial coin offering. That was just, the blockchain was started, and Satoshi Nakamoto sent the first Bitcoin to his friend, and then they kept sending Bitcoin between them to create Bitcoin, or his or her friend. Anyway, so these payment tokens constitute maybe 15%. There are more asset tokens. These are really rather like equity. They give you dividends in a company. Or they could be more like bonds where they pay regular coupons. So these are for capital raising. Some are payment and utility, like Ether is very much used for payments, but it's also the utility because gas is measured in Ether. And you have other hybrid tokens, but the vast majority are utility tokens. And now this utility space has been subdivided further into decentralized finance tokens or non-fungible tokens and other sub-classifications that are becoming increasingly popular. Let me quickly show you this video. So this video starts in January 2014. You can see on the timeline here. So the pink means it's stateless or unknown. Blue means Europe. And the Ethereum one, most of these are domiciled in, I don't know, the Seychelles or something like that. And the size of this little bubble and the location tells you the time. The size tells you how much was raised. So here's the decentralized autonomous organization, which raised 168 million. Ethereum, and there's the first EOS one, which raised, it went on for a long time, that EOS one. Most of them don't go on very long, but you can see the amount raised is increasing over time. And this stops in August 2018. And that was the sort of beginning of the ICO bubble, 2018. And you can see there are a few very large ones. For example, Huobi, this was to start a new exchange, which is now, I mean, the Coinbase exchange was valued at 100, or was it 100 billion or something? I can't remember, I always get my zeros wrong. But they're going, the exchange is now going an IPO for the exchange. The ICO was used for like the venture capital, the seed funding. And Telegram, this was the first Telegram, which was fine, but the second Telegram, they raised billions on the pre-ICO stage. I'll talk about that again in a minute, what the pre-ICO is. But the Securities and Exchange Commission by then had got very concerned about the classification and insisted that Telegram was actually a security and ordered the second ICO to be, although it didn't get to be an ICO, it was just venture capital funding, but it had to be repaid to all the early investors. But later ones soon went into billions, like EOS was 4.5 billion for the second one, and that went through. It's strange that EOS, having raised so much money, has not yet become so I mean, it's a competitor to Ethereum. That's what it's always pitched itself as. But the coin itself has not done very well. Still, it's just Bitcoin, which is being used as a speculative asset. That's why I'm going to be focusing on that later on. The actual valuation of these is what I'm going to be talking about today. What sort of factors tend to indicate that the ICO is going to be a long-term success in the company? Something like Bancor has not done very well, even though they raised a lot of money, whereas Huobi did extremely well. But I'm not actually going to be focusing on the post-ICO success of the company. That is part of the paper. I'm actually just going to be looking at the amount that is raised. What determines how much can be raised if you were to do your own ICO? And you don't need to have a track record as you would if you were running a company that you wanted to go on an initial public offering on a stock exchange. In fact, most ICOs today would have an immediate exchange backing if they're going to be successful. Either Uniswap, which is a decentralized exchange that I spoke about this morning, or the Binance Launchpad. One of the reasons why Binance has become so popular is that instead of having to do your own ICO and then going to ranking sites like CryptoCompare or CoinGecko or CoinMarketCap, and through the ranking get at the same time a good relationship with some exchange. There's hundreds of exchanges, so that your coin can actually be traded post ICO. You can actually get rid of the ranking site and go straight to the exchange. The ranking sites will still pick you up, but they won't be instrumental in directing investors to the exchange that's paying them. So that makes coin ranking sites' income slightly changed. So in this section, I'm just going to be talking about the paper that I'm preparing with Michael on the changing face of initial coin offerings. There's been a huge amount of research. I mean, if you just look at Scopus or any other Google Scholar or whatever, there have been, I was at the beginning of developing GARCH models. In fact, I wrote a paper where I programmed one of the first practical GARCH models for banks before they were available in eViews or SPSS or wherever. You can get a GARCH model off the PEC, but in 1990 you couldn't. You had to work with a C programmer in those days to build GARCH models and optimizers. And there weren't that many papers on GARCH models at that time. And then there was this huge explosion. I mean, still there are too many papers on different GARCH models. But we find the same in crypto now. If you just look at the vast number of topics as well, there are so many new topics for research that have not existed before in financial markets. Things like exchange arbitrage, for example. That's just one of, I don't know, 100 research ideas that could be developed. So this is looking at, first of all, as Michael likes to, a very thorough examination of what's been done before. And we found about, I don't know, 150 papers already. And anyway, so we get ICO Bench as a primary data source, but unfortunately these sources are drying up now. One of the reasons why we haven't published the paper is that we want to look at, they're coming back. I mean, they really dried up in 2020. It was very few ICOs. And now ICOs are, I mean, if you just look at some of the data that we get here ending 31st of March, 30th of June, some of them haven't even set set their dates. Unknown, November. This is going to be a very long one. Typical time for an ICO is only about a month, but this is planned for about 6 months. This is a blockchain ecosystem for cinema, film studios and so forth. I mean, any project you like. Let's have a look at Cinematron, shall we? Okay, so the ranking site will give you information. I have never looked at this before, but they've made themselves a little video. They call themselves a utility token, and it's going to be called LUT. Starts in 19 days, 22 hours. Bonus Bounty platform is on Ethereum. That's where the smart contract will be residing. They accept Ether, Bitcoin, Tether, and any fiat currency as well. Minimum investment is $1,000. The soft cap, if they don't reach the soft cap of 1 million, it won't go ahead. There's a hard cap of 15 million, and any funds raised above 15 million should be returned. The Cayman Islands, typical. And is there a whitelist? Is there a know your customer? Well, yes, apparently they are being careful about whose money they take, and restriction US and China, because both of them legislate against early investment. Most of this is centered around the London markets, which is why I know quite a lot about what's been happening in advance by talking to people in London. These are the keywords. This is the 5 expert ratings give it the rank of 3.1, and you can see on the rating methodology they look at things like the team, how large is the team, what's the background of the team, what information, what does the white paper look like, what's the website, what's the product presentation like, marketing, social media. So the rating, in other words, how successful they think it is, gives us an idea about what factors should be successful. And this one has a sort of average rating. Let me have a look at another one. These have got higher ratings, but no end date. Let me just go back to a more recent one. There may be more information there. Look at this one, Tycoon, rating of 5. But you see, I don't believe these ratings. You need to go to Black Dragon and get more information that is private information. Any public information is probably already going to be discounted. So if I have a look at this one, the Tycoon one, so the pre-ICO has ended, and they're still going ahead with the ICO. The pre-ICO is one where the bonus is given for the early investors. If they get the coin, because what you exchange, you put money and you get the coin, and the coin might be valued, it might go to the moon, it might plummet, who knows? But it's a gamble that you take on the company, that once the initial coin offering has ended, then the coin, you're going to get a lot of value for money. But the people on the pre-ICO, the people that came through Black Dragon and places like that, will have got a better price. One Tycoon token would be something like, I don't know, $0.50, 0.05 of a dollar, not what, this is the ICO price, okay? And the price can change, if it's a very long ICO, the price can change during the ICO. So that bonus or bounty is associated for getting early investors. And we can have a look at their website, see how good they look. Join the social, so this is a Tycoon is probably a bit like Telegram, it's a social media. The crowd sales ends in 14 days. Last chance to buy here. Of course, after 14 days, the price will change. It should be, you can trade it. Yes, it's on Binance. So that's probably why it's got a high ranking, because Binance do quite, it's a sort of rosette of value. if it's integrated with Binance, so we could go have a look at what is happening on Binance. Okay, so no, this is that's just the Tycoon page. Anybody can look at Binance, but what is the coin called? TYC. So if I just have a quick look at Binance and see if I can find I need a search. So I almost always just go on the derivatives thing here. So have I got a search function here? Yeah, search coin. TYC. No, that's just futures spot. I know it doesn't seem to be trading there. Okay, but anyway, that's the Tycoon coin. So I think I've given you a reasonable idea of what's involved. You need your own website. You need a bit of a video. Here's a Tycoon video, social trading. Let's have a quick look. Nice and short, 129.
Is the first social crypto trading platform with a unique and fully automatic copy trader technology. You as a follower can diversify your trading portfolio by choosing your favorite traders to maximize your profits. You can allocate any individual amount to every trader you want to follow. You don't need any knowledge to use Tycoon. It is easy to understand for everybody. Traders connected to Tycoon are trading with their own portfolio at their desired exchange. Tycoon constantly monitors their activity and shares the trades with their followers in real time. With this technology, traders can earn an additional passive income, sharing their own trades automatically with their community. Every trader will be ranked based on their success, activity, and community. You manage your own investments at your preferred exchange without giving away your investment to unknown third-party institutions. The communication between the Tycoon platform and the servers will be protected by using the highest possible security certificates, which will encrypt all the data that is sent or received. A small part of any profit will be automatically reserved to reward the traders for their services. Using the Tycoon token grants you a discount to every profit share. Take part in professional crypto trading experience and discover smarter investing by automatically copying the leading traders in our platform, or get copied yourself to earn a second income. Tycoon.io, building the biggest community to share knowledge in crypto trading.
That's really interesting. I'm glad I looked at that. So it's like becoming a fund of hedge funds yourself. These are all little individual traders or mini hedge funds. And yeah, so quite interesting. Back to ICOs. So that's ICO Bench, but I've included links to all these other different websites where we got the data, scraping it off the back end. So as you can see, data overload is pretty obvious. And this list was made a couple of months ago. Probably I could treble the size of it by now looking at the data, but it's very fragmented. ICO Bench was very good, but now we're having to look elsewhere. Anyway, we had an initial sample of 4,152 ICOs ending before the end of December 2019. As I said, we're now needing to, because things change so rapidly, there's no point. We finished the data, we know what the story is, but we need to update now to add on what's been happening since 2019. Otherwise, it'll be an old paper and won't get into a good journal. So we needed full data on the amount raised, the coin price, the supply of the coin, the distribution, the size of the team, and all the other variables which I'll talk about. Also, we had to take out EOS 4.5 billion. There's no point, it would just distort results. The TON network and Telegram, that's the Telegram one. Telegram is called TON. That was the one actually which they had to pay back. And Leo, this is a coin associated with the Brave browser, which I can talk about later. And no, that's BAT, sorry, the Basic Attention Token. Leo was associated with the launch of an exchange. I'll find that out. There's so many tokens, 4,000, remembering what they all do is quite difficult. Okay, so we've got the sample to the end of 2020, but as you can see, 2020 is not great. Nothing much was happening because of COVID and everything, and also Bitcoin price being crashed in March 2020 did not help. So the number of ICOs ending in 2018 were up to about 200 per month, going down to around 50 or 60 a month in 2019, but then just like 10 a month or so, hardly any. And the total funding in dollars obviously matches very much the price of Bitcoin, but a lot of them are accepting Ether is the main thing, because although there are other networks that allow these funding, these smart contracts for an ICO to happen, so that website that I showed you for investing is a distributed app. It's not an ordinary app that you would use when you log in, because there'd be a smart contract that would record everything on the Ethereum blockchain for your investment. So it's very secure. But there was a lot of congestion on the Ethereum network because of all these ICOs. And in particular, the ones that are decentralized finance have so many smart contracts as part of the company that the Ethereum network got very, very clogged about 6 months ago, leaving the space for places, Polkadot or maybe EOS, goodness knows what's happened to that one though, to move up and take some of these smart contracts as well. Anyway, so that's the sample. And this is just an overview of some of the previous literature, those that are published in the better journals, because, as I said, there are more than 100 papers, a lot of them unpublished, SSRN, and so forth, or the archive. I forget what this there's the double asterisk, I remember now. We are using the log of the amount raised, just because when we, before I do any sort of regression, this is going to be a regression analysis, 2 types of regression. I always just look at the data and look at the data and look at the data, because it tells you so much before I even begin to make a model. And so taking logs helps in terms of linearizing, so it's a log linear model. Some people didn't do that. Momtaz, those ones with 1 asterisk, just looked at the amount raised. And some, like Rosenblum, looked at log of 1 plus the amount raised. So I'm not quite sure why they did that, because it's approximately, well, I don't know. But anyway, log of 1 plus the amount raised. Various different start and end dates, most of them ending by, I think this is the latest, so October 2018. And we saw already that the face of initial coin offerings has changed substantially since then. So we ended up with about 1,000 coins. And the sample size, the largest sample size here was in this paper, 853. Oh no, 980 in this Evgeny Landres paper. And 0 means that it was included but not significant. Plus means it was included and is significant at 5%. With a positive sign. A negative sign here means that it was significant, but with a negative sign. So one of the things that we didn't want to do was to include both price and supply, because they are negatively correlated. The more tokens that you're actually producing in the ICO, the lower the price. It's really the market cap, the target cap, the soft cap and the hard cap, or the target. So you can achieve that in two ways. You can achieve it with a lot of tokens at a low price or a few tokens at a high price. So that collinearity would distort results. So we didn't include both of those, like, for example, this paper. And most of them did include, I mean, I haven't looked at the other results, but they did include both. So I'm just looking at as I said, a few of the paper here. The supply seems to have a positive effect. Maybe it's that the target cap also has a positive effect. We shall see, because that's what I'm going to be looking at. Whether or not code for the smart contract is on GitHub also has either a positive or was at least tried. Strangely, the existence of a white paper was not often looked at, and when it was, it didn't seem to have much relevance in these studies. The existence of a pre-sale, I mean, not all of them have early investors. They might simply have one venture capitalist, or the team might put up their own resources and they may not have any pre-sale at all. But there's very mixed results about whether the existence of a pre-sale actually made much difference. So these are all binary variables that we considered too. We also looked at Twitter, bonus scheme, and so forth. So it's 1 or 0, these variables. The rating, most of the coins had ratings, so that was a discrete variable that people could use, the actual rating between 0 and 5. And that obviously seems that the expert ratings were pretty good. The size of the team also more or less important. The advisory, no. Whether or not, this is the price of Ether, the more valuable Ether is, since most of them are primarily accepting Ether, should have a positive effect. Bonus for early investment, no particular effect. And duration had some negative effect, so did distribution. So the distribution is how much of the coin is retained by the company and how much skin in the game do they have. So if they distribute a lot, they're not keeping very much skin in the game. So you would expect a negative sign, which these papers found. And the duration, the longer the ICO lasts, and we saw with those ICOs, a lot of them were not timed. They would end when they want. And some of them can go on longer than the average of 2 weeks or so. And that's an indication that they're not being very successful at raising money. So we again expect a negative sign there. And the R-squareds are fairly low. I mean, this isn't a sort of time series regression where you get very high R-squareds. The largest one here was 0.38. In this one, Leandra's, it's 0.39 or 0.42. Okay. So I'm not going to include the results. We did include these variables, like some of these papers did, but that we didn't find them significant. So to make it easier to show the results, I'm only going to show you the variables that ended up being significant. And I'm going to have to change that because, as I said, ICO Bench really isn't keeping up for some reason. I think the company's not being very well run. So it's just the existence of any white paper we're looking for now. So social media, having code available, and the bonus scheme for rewarding the pre-ICO were not particularly significant. So we divided the sample, only analysed up to 2019. We're waiting to do another 18 months. We'll do that in June this year to see whether the results are robust. Basic and full just means with the full model, we have a lot of control variables, things like know your customer, whether they accept Bitcoin. Is it actually an initial exchange offering? As I said, a lot of the ICOs are now classified as IEO, There are also security exchange offers. There are lots of subcategorizations that we looked at, but none of those are important. That was just controlling for those effects. Maybe now, in the later period, the IEOs are, with the Binance stamp, more likely to be effective, but we're controlling for those because it's not in the full sample. And focusing on basically things like the target cap. The higher the cap that you target, so that's the hard cap, the more successful the ICO. These numbers have been normalized to be in units of standard deviations, so we can compare them. And these are T-stats in the parentheses. So we're actually finding some highly significant results. We've got a larger sample, and we've not got the linearity that some of the other studies had, because a lot of the variables were had high correlation. Size of the team, also something that is consistently 0.022 or 0.016, it's still relatively constant. The rating, though, seems to have dropped out of significance. Maybe what's happened, as I said, is that the behind-the-scenes rating from places like Black Dragon, that is not public information, it costs to get a seat on that, is what's really driving things now. We don't have those data. Domicility in a tax haven also helps, because tax havens also tend to be beyond the jurisdiction of regulators and less likely, for example, to have to pay back everything like the Telegram second ICO had to. So the total of 1,400, we've got more now, we're collecting another, I don't know, several hundred now, but they were divided into the time when they ended. So this 589 coins all ended before June 2018. And then the next third sample that we look at will all have ended by June 2021. So there's some fairly robust results. It certainly sheds light on this rather mixed picture here from all sorts of different samples and so forth, and shows what may be robust, but without this third section, we can't really tell the story we want to about the changing variance and what determines success. If you, the paper is not even public yet, but I can send early copies because it includes lots of other results about the post ICO success and the probability of actually hitting the soft cap, because if you don't hit the soft cap, then it's never going to be, it's not even counted as a coin because the whole thing is cancelled. Anyway, so that's some of the results that we have in the paper. And now I'm going to take another look at the time. I'm going on to the second paper. In fact, there are three papers here, but I'm only going to focus on one of them. And that's the one with another PhD student, Daniel Heck, who's in his second year now, on price discovery. So this is all econometric analysis based on vector error correction models. And this is published in the Journal of Financial Stability in February. But there are also papers here with, this was a master's student, and these are co-authors in the Peking University, published in Journal of Futures Markets and International Review of Financial Analysis. So I'm just going to go through the one paper, but you can find the other papers on my website. So we did a multi-dimensional price discovery analysis. I mean, traditionally, if you look at price discovery in the Journal of Futures Markets, it will be 2 or 3 dimensional at most. It'll be the triangle of the ETF, the futures, and the index, for S&P 500, like SPY, S&P 500 futures, and the S&P 500 index. And it's very clear, of course, that the futures leads, ETFs then, and the index last. But you know, it all depends on the rapidity of the people whose job it is to replicate index for passive investing on ETFs, and those that are actually trading on the CME, S&P 500, CBOE futures for speculation mainly. And you know that most of the trading is speculation on S&P 500 futures, because the average time one futures contract is held is a few minutes or hours. It's not very long. Futures contracts, of course, traditionally used for hedging, and I will be talking about that on Thursday. But in the standard markets, you have a breakdown of traders. For example, commodity futures can be hedgers and speculators. There's a lot of speculation on commodities, of course. But the CFTC breakdown of trader types will tell you, proportions of how many people are trading for hedging and how many people are doing speculation. But we don't have anything like that here. Not only that, we have a wealth of different exchanges and different types of derivative contracts. So I'm not including options here. That's something that we may get onto later, or somebody else, whatever. But at the moment, because the options markets are much newer, I'll be talking about options a lot on Thursday. Here I'm just talking about futures and these funny things called perpetual swaps. So I want to focus on those a bit. It's because I will be returning to them. They're fabulous for hedging and speculation. In fact, I wanted to show you one of the BitMEX perpetuals, but it wasn't trading very much. Let's go back now and take a look at the BitMEX perpetual. So I haven't got a link here. I'll have to go back to BitMEX. And it immediately takes me to the Bitcoin, and they call it XBT. Some call it XBT, some call it BTC. So I'm going to be using both. And you can see now the spoofing is coming on the buy side, so the price will be dragged downwards. It's like so now the US are involved. Okay, so the trading post 2 p.m. gets very, very active, and you can see that prices begin to move very soon after. So what's this time here? Just trying to figure out what the time is there. Let me have a look at 30-minute data. Okay, no, that goes back too far, so I will look at 1 minute data. So that's 12 o'clock here. Okay, so most of these trades are cancelled. So if you look here, flashing up just above the ticker, you'll very often see 100,000, there's 2 million down there, there's a really big spoof, 1 million there. These are algorithms trading, not obviously, but how much is actually transacted? Okay, so it's all on the buy side, but it's not 2 million, it's a little bit. And what these people are doing, they're dragging it down, because there's some genuine people wanting to sell, but they know they have to go down a little bit to reach the volume there. Okay, now here's a spoof coming upwards again so it's like the forces of Sauron and Samurai in the Lord of the Rings. You can't watch other markets do this sort of thing, but you can go to Binance, you can go to BitMEX, and I find it absolutely fascinating. But it's all manipulation and speculation. Look how much is traded, hardly any, but look at the volumes here. So, I mean, it could be that they are, 99.9% of cancelled quotes, but, and that's in a lot of markets, but whether they're genuine cancellations or not is something that I'm trying to investigate with another paper with Daniel. Okay, so these perpetual contracts have odd specifications. They're like futures, but they never have, they never mature. They go on forever. I'll talk about them more on Thursday, how the funding rates keep the perpetual price very, very close to the spot price, which makes them ideal hedging instruments, but also ideal speculation instruments as well. And then there's standard futures. The backed are more or less defunct now. The whole company just fell flat. They were supposed to be physically delivered Bitcoin futures, and they only started in September, a bit later. That's why in July the Huobi futures, Kraken started in October, and OKEX only in July here. So we don't have complete data for all of them. The CME futures also are difficult. If I do anything involving CME, then we've got to get rid of all the weekend data because CME is closed then. But all the others are open 24/7. And so we've got the spot exchanges, obviously not Binance. You can't have Binance itself because it's a tether exchange and it's banned. So none of the US can trade there. The US can trade in backed and CME. They're not supposed to be trading on BitMEX, but we know they do because of the Lightning Network. And Deribit is semi-regulated. Huobi, Kraken is okay for US investors. Huobi and OKEX are both moving around. You know, one day they're in the Seychelles, the next time they're in Malta. Very difficult to know where these exchanges are located. And no doubt US investors or speculators are trading on them. But obviously Coinbase, Bitstamp, Gemini, Itbit Kraken, not Bitfinex, that's a wash trading exchange. But most of these are okay for US investors, but not the big Binance Perpetual. We're not going to look at that. Nevertheless, I do want to take a quick look because I bought Dogecoin at 5 cents. And as you can see, nothing at all happened to Dogecoin. But if I look at just recently, so it's actually a little bit more than I bought it for. But I was hoping that when Musk had a tweet on Bitcoin and he bought Bitcoin, that he was going to also tweet Dogecoin, and Musk just plays with this market. He makes a tweet and then he makes billions by buying a coin and tweeting it. And I was right, he did tweet it, and it went up to about 70 cents, and I bought it for about 4. But I'm hanging on because I think there's going to be more activity here. But that's just a perpetual swap on Dogecoin. Okay, but you can also look at the order book and see the sort of spoofing going on even in Dogecoin. It's a thing of its own. Looking at, this is something I'm doing in more detail properly. This is just a back of the envelope calculation. It's possible to show that the average holding period is the open interest or average open interest over half the volume, because the volume is counted twice. Every time some contracts exchange, there's a buyer and a seller, but that counts twice, a buy volume and a sell volume. So if you add up the total volume, you'd have to divide it by 2 for the number of contracts exchanged. Other authors they just call it a speculation index, which is the ratio of the volume over open interest. And that's got the advantage that the higher the speculation measure, the more speculation there is. Whereas this one, which I didn't know about other measures, I just made this up. But this one, the lower the average holding period, the more the speculation. And this is looking at data up to January last year. So these were fairly new on the block, Huobi and OKEX. Obviously, Huobi has a lot of speculation, whereas Deribit much less. BitMEX actually less on the futures, and most of the speculation you can see is on the perpetuals. So that's why the work I'm doing on speculation now is focusing on perpetuals. These futures have all sorts of funny maturities, like 1 week, 3 weeks. They don't follow standard quarterly cycles, although there are quarterly futures, but following their issuance pattern is a bit difficult. So as I say, the data actually ended in January last year. Things have changed since then, but just to give you an idea of how much volume is overall, over the entire data period, and we used high frequency minute level data, most of the trading was on the Huobi futures, followed by the BitMEX Perpetual, and then the OKEX futures and the OKEX Perpetual. Within the futures markets, beside Huobi and OKEX, there was a little bit on CME, but not very much. In the spot markets, no surprise, it's Coinbase and Bitstamp that take up more than 50% of the trading. These are the most secure and well-known exchanges. But Bitfinex, you know, if you're interested in doing some behind-the-scenes wash trading and getting some fee rebates, then you can do that. And Kraken. Okay, and in the perpetuals, it's all the BitMEX Perpetual at that time, but now it's Binance. Looking at the specifications here, apart from the backed, which is more or less defunct now, which was physical settlement, they're all cash settled, so they're financial futures. And on the regulated futures, it's a standard sort of thing. So a contract size would be like for gold, it would be 1 troy ounce. Here it's 5 Bitcoin. I'm using XBT in this paper for Bitcoin. In other papers I use BTC. I tend to use XBT for derivatives and BTC for cash. I don't know why. And the margin requirements are tiny on these unregulated exchanges, but really high on the CME and backed. But this is a standard, what we call a direct futures. So it's cash settled in USD. It's just like any other futures. Delivery date last Friday of the month, and then the fees are fairly standard for maker or taker. When we look at the unregulated futures, let's just look at the BitMEX because they're all quite similar apart from the size of the contract. They're inverse futures. The size of the futures is in dollars and the settlement and margining is in Bitcoin. So that's what we call inverse futures. It only makes things more complex when we look at things like hedge ratios and P&L analysis. So whether you're hedging with futures or with options, you do need to be, and you're looking at, minimizing P&L variance, you do have to be really careful about getting it the right way round for these. Traded 24/7, and we are just using the biggest contracts, the quarterly futures. On the perpetuals, there's no maturity, as you know. And the negative fees for the maker on BitMEX, Deribit, not Huobi, but Kraken as well, show that a lot of that volume that we see may well just be artificially inflated wash trading. Okay, so what sort of measures did we use for price discovery? Well, the standard measure is called an information share. It's a bit like an analysis of variance, and I'll go through the mathematics of it in a minute. How much of the new variation came from which source? So there are various generalized information shares. We used or modified information shares. We use the generalization based on the Haasbrook measure. And we also checked robustness using something called the component share, which goes back to 1980s, something that Clive Granger and Gonzalez introduced. But what they all do is measure, when new information arrives to the network, what proportion of the new innovation in the price originates on, like, the Huobi futures, product X, okay? And then we've got the impulse response associated with it, built on the same model. It's all a vector error correction model. When a price jump occurs on some product like Huobi futures, how long does a following product like CME futures, for example, take to adjust to that new market price? How long have you got? If you're watching the Huobi futures price and you see a big jump and you want to trade on the CME, how long have you got to put your trade on to take advantage of the price move, assuming CME is going to follow the move that you saw on Huobi? Or the other way around, what if you see a move on CME? How long does it take, I mean a big move on CME, and that happens a lot on the settlement, I have to say. How long does it take for the price adjustment to happen in the other exchanges? So that's the impulse response. So what we did was to build a lot of n-dimensional vector error correction models specified on the next slide. You've got the handout so you can see already if you want to have a look. And the n was 10, 4, 7 or 8. And in the futures we divided between regulated and unregulated as well. So sometimes we just did the 2 backed and CME, and sometimes we just did the unregulated ones like BitMEX and Deribit. And then we took the leaders from the spot and the perpetuals and the futures and put them all together in an 8-dimensional system. So every day we built these 1, 2, 3, 4 and another couple error correction models every day. So we estimated the models using minute level traded prices and derived from that day a GIS for each of the products and, well, each exchange, I should really say each product in the system here. So the Huobi futures and the OKEX futures and the OKEX perpetuals as well were separately, had different GIS for those. Now, if we do this day by day, you get quite a jumpy picture. So I'm going to show you those pictures in a minute, but I smoothed the data a little, just using an exponential smoother to make it a bit easier on the eye. Just to check that the minute level data were not too jumpy, and we're getting a lot of noise that wasn't that wasn't really robust. We checked results using 15-minute and 5-minute data and different types of information measures as well, and the results are quite robust. I'm not going to go through that here, it's in the paper. So this is the vector autoregression model. So P will be an n-dimensional vector, okay? So it could be, for example, it could be the 10 spot prices, or it could be 4 perpetuals prices, etc., etc. So suppose we've got 10 spot prices here on Coinbase, Bitstamp, Bitfinex, Itbit, so forth. And they're all measured at that minute. So it's the last traded price in that minute. And then we've got this standard disequilibrium term. These are the deviations, called disequilibrium. The long run equilibrium is given by this vector beta, which is the co-integrating vector. If you had like spot and futures, it would be 1 minus 1, for example. You would have for usually it would be 1 and minus 1 for a 2-dimensional spot futures co-integration. And then you get the corresponding sign on the delta. I've covered this in many outlets, including my books, Market Risk Analysis, if you want to find more about vector autoregressions and so forth. So we have all the lags we want, say, I don't know, I think we used 8. We used the Akaki information criteria or Bayesian information criteria to determine the optimal number of lags here. So these are like Granger causality regressions, except you've got the extra term here. So the change in the log price or the log return on BitMEX is regressed on all lagged, I equals 1 from here. So these are the lots and lots of lags. And then you've got your disequilibrium term here, provided they're co-integrating. This would be, and they are of course, very strongly co-integrating. This would be very significant, and the model would not be properly specified without including that. And as long as you've got enough lags, these should be serially uncorrelated innovations, zero mean, and covariance matrix omega. And any autoregression can be inverted using the lag operator or the inverse lag operator and rewritten as a moving average. So if you've got, say, a time series model that's an AR1 model, if you invert that, it becomes an infinite moving average, okay? So you do get this infinite moving average term here, but also we isolate out the lags on the error and on the innovations. So these are all the past innovations from right at the beginning. So at time t, you've got the initial price of the system, that's on the first minute of the day. And then by the time you get halfway through the day, you've got 60 times 12 lags here of the previous innovations. But it can be shown that this, which is the sum of the moving average coefficients, has identical rows. So this phi1 is got row little phi, little phi, little phi. So in other words, when we look at the first variable here, this is the actual price, because we've integrated it. The price on BitMEX at time t is equal to its price at the beginning of the day plus a common price, the same phi times the sum of all the previous innovations. And that is a common term for each of the equations in this vector autoregression. So this is called the common efficient price, all right? And when we take the variance of this, because this ET has covariance omega, this is the total variance of the common efficient price. And the information share looks at the share coming from your particular thing, like Coinbase or whatever your product or exchange is that you're looking at, as a proportion of the total variance. Now, this goes back a long way. This is the Harsbrook information share. And this is the ith term in the Cholesky decomposition. So you take the square root and then you square it. So you can isolate it's like the analysis of variance for the ith source of information. And the trouble with this are many, particularly the non-uniqueness of the Cholesky decomposition for a large matrix is pretty well known, and so we prefer to use, instead of the Cholesky decomposition, the spectral decomposition, because that's more unique. You know, you've just got signs of the eigenvalues could change, but if you have a convention there, this is generally recognized, although it was 20 years later, as being a more robust information share. Some people use a modified information share, which is slightly different. Anyway, so those are the information shares. I won't go through all those different measures for, see what the time is now. Okay. So the results here are, as you can see, fairly over this period, stable. Coinbase has almost always got about 20% of the information share on the spot markets. Bitstamp, gone down a little bit, but again, it's got about 10%. Bitfinex about 10%. Kraken maybe 10%. And OKCoin going less and less until Bittrex really has the least information share. When we go to the futures and the perpetuals, Huobi took off. Remember, Huobi had that successful ICO, and when I showed you the whale alerts, that's one of those exchanges that's taking some pretty big onboarding of new Bitcoin, and it just exploded into the influence, not only in its perpetuals. Oh, sorry, this is OKEX perpetuals, and this is Huobi. I should change the colours of those. I suppose blue being the recent one. But OKEX is very similar to Huobi as well. So Huobi futures here, OKEX futures here, OKEX perpetual there. So very soon after launch. But Binance is taking the share more and more. BitMEX is not having so much of an influence anymore, which is good. And they were under scrutiny by the SEC, which stopped a lot of the US speculators going there. And they're almost certainly using the OKEX Lightning Network and the Binance on-chain flows to trade on OKEX and Binance. When we put them all together, we find that the CME, for example, for all its pomp and marketing, is having very little influence on the actual price, but it's a different type of contract. It's regulated, it's for investors, but they are having to watch the other exchanges if they're not using it for hedging. And why would they? Who else would use? Only miners use Bitcoin for hedging, I suppose. Maybe some hedge funds might. Yeah, no, hedge funds might be, they might hedge their Bitcoin exposure completely and just look at smaller coins with Bitcoin as the numeraire. That also happens. Okay, so the impulse responses is the final thing I'm going to talk about. And then we've got much more flexibility to answer questions, also show you some of the other things I haven't spoken about today. So how long have you got if you're a CME trader, if you're an institution and you're watching BitMEX? How long have you got, and you see the price on BitMEX move, to actually put on a trade in CME? Have you got 1 minute, 5 minutes? How long does it take? So how long, the other way around, if there's a price jump on CME, as there often is just before settlement, do the unregulated exchanges react much to that or not? So for that, we're going to do two-dimensional vector autoregressions. And just looking in January, so all the transaction data in January, and suppose on the 31st of January that there was a jump, and we'll do an impulse response for a hypothetical jump. And then we'll measure the spread relative to the CME price. So given the CME price is a futures price, if this is a spot price, and if the market, this could be a spot or a futures price on the unregulated exchanges, but the CME is a futures price, it's a monthly future, so it's quite far up the curve. And so the spread could be positive or negative, depending on whether the market is in backwardation or contango. In a backwardation, you'll find that this will be negative for a spot, but if it's a quarterly futures, it would be positive. In contango, when as you go up the curve, so the monthly futures have a lower price than the quarterly futures, and the spot has a lower price than all of them, that's the contango rather than the backwardation, we would see the opposite signs happening. So keep an eye on the signs here. And we did quite a lot of mathematics, which is in the appendix here, to compute something called the expected spread after the shock. Again, it's on the paper. I'll show you where to get it in a minute. So getting to the long-term equilibrium price after a shock on Huobi futures, okay? And this shows what happens with BitMEX Perpetual and Coinbase. So the Huobi futures price this is a shock on Huobi futures, BitMEX Perpetual and Coinbase. Shock on CME futures. So this is the spread between the CME, this is this previous thing here. So this is really measuring what the CME price is doing. That's why I haven't shown it here or here, because this is the spread from. And so the fact that they don't all settle down to exactly the same level is because of let me think, this is quarterly. The Perpetual is very, very close to spot, and Coinbase is spot. So we find that the spot is above the futures, Perpetual even further above. Yeah, so I'm not entirely sure about the shape of the contango there, and similarly here. The point to note, though, is that you do have, well, this is in minutes, okay, so you do have maybe 1 to 3 minutes to adjust, but most of the adjustment is more or less instantaneous. Whereas if you do the shock on the CME futures, there isn't an adjustment. The other exchanges are not really looking at price discovery from CME futures, as we already saw. So the final bottom line, and this is why we published this paper in the Journal of Financial Stability, is that there are a lot of applications for ETFs on Bitcoin and other crypto in the US. They've been going on for a very long time, and the SEC has not agreed to any of them. And what they're looking for is a sign that the market is maturing. And that's what the CME are trying to show, that because of their derivatives products, this market is now becoming a properly mature market. And our paper was all about the opposite, that there is still a huge amount of unregulated trading activity which is dominating the price of Bitcoin, and that's what we've been seeing recently. So before I answer some questions, I'll just quickly point you to where you can get more data. I just finished my own website, a new version. It had been down for ages and I hadn't had the time to do it. Oh, no, I haven't. www. Here we are. No, come on. The old address still works, carolalexander.org. So this is my new website. And if you go to research, so there are academic publications there. Those are links to the ones that are open access. What are we talking about? This one here, for example. But I'm happy if you haven't, you should have subscriptions. But if you haven't got subscriptions, then you can always ask me, and I'll send you a PDF of a sort of preprint. Also, I think on the University of Sussex page, which I forgot to link to, but I have a lot of my papers in preprint version are available on University of Sussex pages. Also, if you want to find out more, there are a few videos. A lot of them are about, there's quite a few videos and blogs about what I'm going to be talking about on Thursday. This is not necessarily relevant. And yeah, okay. So there we are. If it's all right with you, I will take some questions.